Gold's a matter of time to stay above $3,500 an ounce. The key thing I'll be publishing on Monday, about by the time this comes out, Monday, August 4th, is my outlook for gold to stay above 3,500 an ounce. Little trigger is that bottoming volatility in S&P 500. Silver typically trades 2 times the volatility of gold. It's the devil's metal, leverage gold for a reason. And it should be up double what gold is. On a one-year basis, it should be up double what gold is. It isn't. So most of the precious metals, gold, silver, platinum, palladium, have just been rallying on the back of gold. The S&P 500 ratio, gold's been outperforming the S&P 500 for a few years. If you look at gold divided by the S&P 500, those per ounces, it's popped up on a year-end basis to the highest since 2015. So gold's starting to take off.
The undercurrents in the precious metals market are shifting fast. And Mike McGlone is one of the few analysts connecting the dots with clarity. As silver surged toward the elusive $40 per ounce and gold prepared for another breakout attempt, intervention struck. News of a potential USD trade agreement hit the wires, and within minutes, gold dropped $40, and silver was forced back from $39.91 to close at $39.50. For McGlone, these moves reflect not strength in fiat, but desperation to suppress the one asset class that signals systemic stress: monetary metals. In this environment of manipulated headlines and shallow rallies, McGlone's framework remains grounded. A veteran commodity strategist at Bloomberg Intelligence, he continues to emphasize gold's strength even as U.S. Treasuries lag. While he concedes his Treasury call hasn't yet played out, gold has done exactly what he anticipated, and more. According to McGlone, there's nothing visible on the horizon that could drag gold below $3,000 an ounce. Instead, he sees mounting evidence, including a bottoming in stock market volatility, that suggests gold is preparing to surge toward $3,500 and beyond. This isn't just McGlone's view. Major institutions are now echoing similar sentiment. On Monday, Citi raised its 3-month gold forecast from $3,300 to $3,500 and adjusted its expected trading range to $3,300 to $3,600, citing a worsening outlook for U.S. growth and inflation. The signs are converging. Central banks are losing control, volatility is reawakening, and capital is quietly rotating into safe haven assets. In this video, we break down McGlone's latest analysis, including the silver market's near breakout, the $3,500 gold signal, and why institutional forecasts are beginning to align. We also explore the subtle power plays behind price suppression and why, in McGlone's view, this manipulation will only accelerate gold's upside when the dam finally breaks. If you value real insight over recycled headlines, like this video and subscribe for more weekly updates. The revaluation of monetary metals isn't coming, it's already underway.
Silver's had a good run this year. It's popped up to near 40. But you look at it on a year-to-date basis, it's running parallel 27% with gold. That's a bad sign. Silver typically trades 2 times the volatility of gold. It's the devil's metal, leverage gold for a reason. And it should be up double what gold is. On a one-year basis, it should be up double what gold is. It isn't. So most of the precious metals, gold, silver, platinum, palladium, have just been rallying on the back of gold. And now we're seeing that was with the stock market doing well and copper doing well. Now we're seeing copper probably rolling back over. And gold is, to me, the only enduring metal. I think this can keep going up this year, particularly if the U.S. stock market continues to decline, which is somewhat my base case. I have some indications for that. First of all, we're August. This is summer doldrums just kicking in. But you look at 30-day volatility on the S&P 500, it just bottomed about 7.2%. That's about the lowest in 4 years. And we're just kind of flipping over. And we had I think we're seeing a bit of a sea change in what's happening with sentiment in U.S. equity. By highs, let's define highs. The U.S. stock market to GDP right now, and last year was the highest since 1929, if you put it on a year-end basis. The highest ever versus the rest of the world, and that's starting to back up a level. The highest in about 25 years of commodities, and the highest about 20 years versus gold. That was at the end of last year. Now it's all starting to revert. So that, what you just defined, was the wealth effect. And you also, I nailed it, top 10% of income earners in this country own 80% of stocks. There's going to be no way that they're going to really shut down inflation, shut down consumer spending basically, and shut down buying houses and condos in Miami until the stock market goes down. It's just, there's only 2 times in history. We've got similar examples in relevant history. 1989 in Japan. I started in business in 88. My clients were Japanese. I remember that one well. And of course, 1929 in the US. So to me, this is what potentially has just started to revert as we speak now. and what's going to stop it. So to me, that's something I've been waiting for almost 2 years. I think it's getting started, but it's that reverse wealth. And the key thing is you get to a certain point where you lift risk assets so high, they just can't go up any higher. Have we reached that point? Now, people have heard me say this a few years before. I've pointed that out. Yes, I've said that too early. But one key indicator of that is you look at that gold to S&P 500 ratio. Gold's been outperforming the S&P 500 for a few years. If you look at gold divided by the S&P 500, those per ounces, it's popped up on a year-end basis to the highest since 2015. So gold's starting to take off. ETF holdings are kicking in, and central banks are still buying. So I'm still biased to gold outperforming the stock market. And to me, the key risk for everything is what you mentioned is when you get to 2 times GDP in the stock market, it is the economy. Now, we've seen that. I'll give you an example. Last year, S&P 500 was up, 20% or so, $13 trillion, which was 40% of GDP. This year's correction was down about $13 trillion max. That's total market cap of stock market capitalization. It was about 20% of GDP. That's 40%. That's the most ever since I think one of the key indicators I've been watching is I have to go to cryptos, partly because we have a president who's completely tilted that way to help get him elected. And I've been looking at Bitcoin gold ratio as a great indicator forever. That Bitcoin to gold ratio right now, about 34 ounces of gold per 1 Bitcoin, has been flat since 2021. That's 4 years. That's not a good sign. It was a leading indicator of the stock market before. Now it's been lagging. So I think that this whole area is just ready for a bit of a reversion. Gold seems to get it, and all risk assets should suffer. Now, we saw copper drop recently for other reasons, but copper was not showing, it was showing pretty significance above 10,000, pretty significant resistance at $10,000 a ton on the London Metal Exchange. Looks like it's going to, London metals can trade lower. And then we have significant situations, what's happened in the rest of the world, facing unprecedented tariffs from the world's largest demand pull goods importer. And this was a quote today that I enjoyed seeing, didn't enjoy seeing it. I lived in France for about a year. About French wine industry might face $600,000 of job losses and $1 billion of profit losses from U.S. tariffs. And I lived there, and I remember they always charged about 20% in U.S. wine, and U.S. charged nothing in tariffs. I mean, that was just obnoxious. Like, sorry, but you had a great time. You should say thank you. Now it's just normalizing this disparity in trade flows, and that's a key lesson I learned in the trading pits in the 90s, in the 80s too, is that free trade isn't free. It's an aberration, and that was a book by Robert Lighthizer. But either way, the point is, these tariffs are going to shut down the rest of the world, push a major deflationary force. China spreading their deflation all over the place. You're seeing that in things like gold going up and crude oil going down. And now the number one thing holding everything up, the U.S. stock market, might have started tilting downwards. Part of the reason I'm still bullish gold and U.S. Treasuries, and I've been wrong for a while on U.S. Treasuries, but not on gold. And I don't see what's going to push gold below $3,000 an ounce, but I see now the latest signal for it to get above 3,500 an ounce was this bottoming volatility in the stock market. Don't really know. I suspect they're more bullish, but they'll be rallying on the back of gold, which is bullish. The thing I'm worried about is the stock market going down, but still bullish that whole space, and gold miners are part of it.
Okay, so what score would you give it?
Less than gold. I'd say if gold, I'm putting it about 70 or 80. We'll put miners closer to 50 or 60.
Silver, 1 to 100, buy or sell?
It's up there with gold. With the miners, I'd say 50 to 60. Silver's running up on the back of gold. The problem is it's an industrial metal, more correlated with copper. It's running up on the coattails of gold. And let's remember, the main buyers of gold have been central banks, and they're not buying silver. If the stock market goes down, it's closer to 10. It's all about the stock market. I'm bearish the stock market, so I'm closer to a 10 on that. I think that gold to S&P 5 ratio is going to go back to 1 to 1, and it's way overdue for it. It's what it's done historically. So I'm still very bullish gold, but the 60-40, I think, is so old. And remember what it is, 60-40 really isn't 60-40. It's really 10-90 because of the volatility you get in the stock market. And I think there's certain times you're supposed to be underweighting risk assets, and certain times you're supposed to overweight risk assets. Now, COVID, when the U.S. pumped all that money in the system, that was overweighting risk assets. Now you're supposed to be underweighting risk assets, which includes that 60. And I think gold's part of what should be in the 40 part. And maybe overweight gold and Treasury.
While much of the focus remains on inflation, Mike McGlone is sounding the alarm on a growing deflationary shift, drawing parallels between the U.S. and Japan's long-term economic stagnation. We're all turning Japanese, he warns, pointing to the stark contrast between China's long-term interest rate now around 1.7%, and the U.S. 10-year Treasury yield, which recently peaked at 5.15%, its highest in nearly 2 decades. In McGlone's view, this divergence highlights the deflationary pressures quietly building beneath the surface of Western economies, while Eastern central banks, like the People's Bank of China, are already cutting aggressively. China's recent 10 basis point reduction in its 7-day reverse repo rate and surprise cut to its loan prime rates underscore this pivot toward monetary easing. McGlone is also closely watching the gold to S&P 500 ratio, which has surged to 0.54, a level not seen since 2014. He argues that this metric offers a clear indication that the market is entering a late cycle phase. From his perspective, gold's climb to record highs isn't just about geopolitical risk or inflation hedging. It's about the market beginning to price in the endgame of this economic expansion. The collapse in the S&P 500 to gold ratio further supports his view. That ratio has dropped to a mean of 1.9 in March 2025, down from 2.3 in December and a peak of 2.5 in February, marking the lowest level since the pandemic and signaling a quiet rotation out of equities and into hard assets. Let's get back to the interview.
I think Mr. Trump has put himself in a bit of a lose-lose position versus the Fed in the market, pushing back on Federal Reserve independence, a good factor that's helped create this massive premium in U.S. risk assets over the last 50 years, up to the peak last year. Is a lose-lose. I mean, if when he does put in a new chairman, he'll be considered a lackey, probably cut rates. But the key thing is, what stage will we be by the time that happens in about 10 months in May? And I think it's going to be more the Feds already have started cutting rates because the stock market started going down and told them to, and maybe the new chairman will cut faster, but he'll get those rates because one thing that Mr. Trump knows, he's a very clever person. I do not underestimate this human being. And the best way, I think, to get yields lower on mortgage rates, which is a key thing he's been pointing out, is for the stock market to go down. And the key thing, remember, is 55% of a U.S. population, about 55% are wage earners. That's the population voted for Mr. Trump. They're not so exposed to the stock market versus the top 10% who don't really vote for him. That's the key thing to make it happen, and it's going to see how we happen by next year. But he's also set up a good fact of plausible deniability if and when the market just has a little bit of normal reversion. He can blame it on Mr. Powell. He will, but that's his nature. But the thing, you see the lose-lose there? It's a win-win for gold. And the point is, when you push back on something that's so ingrained in the importance of a first world country's proper management of the economy, well, I think we're all turning Japanese. And China's at 1.7%. Long end right now is 4. Just the peak this year was 5.15%. That was almost the highest in 20 years. And that's about when Bitcoin peaked too. Now Bitcoin's below that level. You see what's part of the driver, risk assets. I think it can easily get back down to 2%. And that's long term, or at least where copper says, and copper's going to 3%. I do love overlaying the dollar price of copper with that U.S. 10-year note yield. Right now, U.S. 10-year note yields, as we speak, are 4.22. Copper's a little bit above that. Copper got way too high, and they'll probably go down together towards 3 initially. But we have to see what happens with the economy and the stock market. And to me, now we're at that point where it's so expensive. The economy is the stock market. If we just have a little bit of a back and fill, that's your recession we're way overdue for. And this key thing I'm really concerned about is when you have a new person come in, say second term, and try to make the country great again when we're already at the highest valuation ever versus the rest of the world in terms of the stock market. I look for signals to see if it's not different in time. I start with gold, backing up. Right now I'm looking at just my updated S&P 500, gold divided, ounces of gold divided by the S&P 500. It's jumped up to 0.54. That will be the highest, if we end the year there, the highest since 2014. And so to me, the point is we've reached the end game. Gold making record highs, just figured that out. And then we have one major area where it's so easy to define. We all knew in 1999 there was a major area to just tweak the bubble and purge all these excessive internet stocks. It's cryptos. I mean, it's just silly, stupid, somehow expensive some of these things are. Like Dogecoin, it's like number 8. It's worth $30 billion. It tracks nothing. Shiba Inu is worth, let me check the latest on that. It's worth $7 billion. It tracks nothing. Bloomberg Industrial Metals Index is basically flat on the year now, with the S&P 500 up about 7%. That's a real bad sign now that copper's given it back. I'm always been concerned about the miners. Obviously, we've had a decent bounce this year, but if you look at in terms of the GDX index divided by GLD, it's been buried forever. It's bounced, but central banks are buying the actual underlying metal gold, and you just have to, when you look at any other metal but gold, which everything else but gold are industrial tilted, most notably silver is more industrial now than it is precious. You have to look at China. What's happening in China? Start with that 1.7110 you know. What's happening with iron ore? It's stuck below $100 a ton for how long now? It's trading lower. I just don't see, and what's happening with crude oil, all these things, I don't see the upside for industrial metals, particularly if the U.S. stock market goes down in this case. I still look at gold as the best performing assets. And the bottom line, again, Gary, is I hate to keep going back to it, but I have to focus on, if you're running any type of money, any type of value risk now, you have to know that if we just take back 10% and that S&P 500, that's all that's going to matter. And so far it's potentially starting to happen. Unlikely. I'm fully sticking with the rock beating stocks. I think gold's a matter of time to stay above $3,500 an ounce. The key thing I'll be publishing on Monday, about by the time this comes out, Monday, August 4th, is my outlook for gold to stay above 3,500 an ounce. Little trigger is that bottoming volatility in S&P 500, and I expect that to happen. But remember, it's an industrial metal, much more every day. And that silver to gold ratio, when it peaked around 100, yeah, that's a pretty good peak. Right now with silver to gold, we're running around 90.7. Silver's cheap to gold, I get that, but you need the stock market to go up for silver to outperform. And this is what's been different about silver. It's still underperforming. It's going to have the headwind. And if we get, just like I said, if we get a normal backup in the U.S. stock market, I'm looking for 50% drawdown. We haven't had that. 5-0? Yeah, we've had two in the last since 2000. And that just gets us back to one-to-one GDP and the Buffett model you mentioned. Now, it's not going to be overnight, but that's a macro bigger picture. Gold to continue outperforming most risk assets, most metals, particularly silver, platinum, palladium, and copper, and treasuries, potentially U.S. Treasury bonds, to be the next big trade. Tariffs, I think, are part of it. It's a long-term thing. Just to point out, it's already happened twice in the last 25 years. People seem to forget that. But it's the key thing to remember about what happened in this country. I'm from the heartland. And when you're in the heartland and you shut down a local plant to outsource supply for any type of, any type of product or widgets you're making, it's very politically incorrect, but you increase your profits. That's the bottom line. All capitalists are profit maximalists. They have to be, more so everywhere in terms of competition. But what's happening now is we're shutting down some of those profits.
Mike McGlone remains firm in his conviction that gold and U.S. Treasuries offer the most compelling risk-adjusted opportunities in today's uncertain macro environment. He interprets recent bottoming volatility in the stock market as a signal that markets may be entering a calm-before-the-storm phase, suggesting that significant monetary or financial shifts could be on the horizon. While he acknowledges that his bullish stance on treasuries has been out of favor, he continues to see long-term value in bonds, remarkably as economic indicators suggest deflationary pressures rather than sustained inflation. McGlone also emphasizes gold's resilience, noting that there's little standing in the way of the metal surpassing $3,000 per ounce, possibly reaching $3,500. In his view, gold's persistent strength isn't simply a reaction to inflation or geopolitical risk. It reflects a deeper market awareness that the existing monetary system is strained. Rather than waiting for a significant policy shift, McGlone believes markets are already quietly pricing in the end of the current economic expansion. In this framework, gold is not just a store of value. It's a leading signal of systemic transition, guiding smart capital toward stability. At the same time, much of the public remains distracted by the surface-level calm of the market. Did you find this breakdown helpful in navigating today's complex markets? If so, don't forget to like the video, subscribe to the channel, and share it with fellow investors who are looking for clarity in uncertain times. We're committed to bringing you insights from the sharpest minds in finance, so you can stay informed, stay prepared, and stay ahead of the storm. Thanks for watching.